US Treasury yields hit 7-year highs in October after September saw the worst monthly performance since January. Increased issuance and a strong US economy have been weighing on the bond market. Joining me now from New York is Gershon Distenfeld, co-head of fixed income at AllianceBernstein. Gershon, thank you so much for joining us. So, to what extent do you think that the current volatility in the equity market has been driven by the sell-off we saw before in the US Treasuries?
Well, it's interesting. Every time we get into a period where you have low volatility, I think investors seem to expect that to just persist forever. So I think, it's a convenient excuse to blame the equity market volatility on the bond market. It may be partially true, but I don't think that's the entire story. I think we have to realize that we're coming out of an unprecedented policies from really not just the Fed, but central governments around the world. And that's going to mean that the unwind of this easy policy is going to create some volatility and some more uncertainty in the bond market.
So until recently, it seems like this bull flattener was the real consensus trade in the US bond market at least, but the curve started to steepen a bit again. So what's your view on how the curve moves from here?
So I think the reason that the curve is starting to steepen is that investors are starting to pay attention to long-term inflation numbers. So if we think about the various drivers of inflation, certainly the U.S. economy and the stimulus we've been providing from a fiscal perspective is inflationary, at least in the long run. Some of the trade policies that we know President Trump is pursuing would also be inflationary. So, and you combine that with the third factor, is that I think the Fed has recently made clear they're willing to let inflation run a little bit hot. Just like they were willing to tolerate on the downside, they're willing to tolerate a little bit on the upside. So all those things mean inflation is going to become something that has really been the back rear mirror for investors for a decade and a half at least, and it's going to become the forefront. And that could mean steeper curves, might mean a continued higher US dollar, but it's going to be uncertain, and that is going to mean we're probably going to have more volatility in the just general bond markets than we've seen in quite some time.
So if you're nervous about inflation, does that mean that you think that the Fed should potentially be tightening a bit more quickly?
We've thought for a while the Fed should have been tightening more. We think we should already be higher than we are today, and we think the Fed should go faster than they have been. We tend to focus on changes. So, when the Fed moves 25 basis points or not, we take that as a big signal. In reality, 25 basis points doesn't mean a whole lot to the real economy. If you were dropped in from Mars, you didn't know anything was going on the past 10 or 15 years, and you look at the U.S. economy, and you'd see basically we're at full employment, according to most economists, and inflation is ticking up and maybe starting to be a little bit above what we'd like to see it over time. And you'd say that the overnight rate should be higher than normal, yet it's still, whether you think it's somewhere around 3 or maybe even a little bit lower, it's lower than that. It's still in the 2 to 2.25 area. So yeah, we do think that the Fed should be hiking further. We're calling, I think markets are still only pricing in 2 to 3 hikes next year. We're calling for, well, we're not predicting the Fed's going to do this. We think the Fed should go 4 to 6 times next year.
But given where we are in the economic cycle and the fact that there isn't, as you kind of alluded to, the fact there isn't really that much more spare capacity, doesn't that raise the chances of a potential Fed-induced recession?
Well, look, we're 9 years into a recovery here. I don't think we've yet solved the way for us to have kind of normal, steady growth. There are always cycles, and the Fed can control things only so much. We tend to give, I think, too much blame to the Fed when things go bad and too much credit when it goes good. It's only one factor. There are a lot of other factors at play. And look, we are, again, 9 years into an expansion. History would suggest that you are due for a downturn. The question is, can it be, whenever that downturn happens, whether it's a year, 2, 3 years from now, how deep is it going to be? I don't think anyone expects anything like 2008. But the question is, will we have a mild recession at some point, or will it be a deep recession? And look, the Fed can certainly play into that, but it's not the only factor at work.
So if a recession seems like it could be potentially around the corner, whether that be 1 or 2 or 3 years, where do you see the good opportunities in the bond market?
One could certainly point to parts of the bond market that are somewhat undervalued, such as parts of the emerging market debt landscape. But I think the bigger issue for investors is really to focus on the potential returns not just from bond markets, but from other markets as well. I mean, the global equity markets are not particularly cheap, particularly in the U.S. That doesn't mean we're going to have these usually negative returns. What it does mean is that investors should not expect the kind of returns they've become accustomed to over the past decade. So what should investors really focus on in fixed income? Make sure you have the right risk profile. Fixed income is often lumped together. There's really two different parts of fixed income. There's kind of the higher income part, which tends to correlate to equities, and people needing yield, they tend to have way too much exposure to that part of the market. And not enough exposure to duration. So despite the fact that I do believe that yields are going to continue to go up, inflation may be a problem, still investors might want to check how much real duration risk do they have, because as we saw last week, right, when equity started to sell off, whether or not it was caused by bond yields moving around, bond yields then, at least high quality bond yields, rallied. And you want to have some of that exposure in your portfolio in case your risk assets do start to sell off, in case we do go into a recession, where that paper tends to do pretty well.
Well, I think that's one of the really interesting things that we've been seeing at the moment, is that we've been seeing a bit of a sell-off in equities and bonds, which isn't really usually traditionally the way that assets tend to play out with each other in relation to each other. So do you think that if we continue to see selling in the equity market, that's likely to see a rotation trade more into bonds?
So hard to say if you'll see a rotation into bonds, but that short-term correlation usually only lasts so long. At some point, if you get a big enough sell-off in the equity markets, then you do have a flight to quality, at least in the short run, and higher quality bonds rally in yield and have very, very good returns. That's something that, you know, through people said it wasn't going to apply, you know, when yields were under 2% on the 10-year. It still applied. When there was a risk sell-off in the equity markets, bond yields tend to rally. Doesn't mean there can't be short-term, you know, positive correlations where they both sell off, and we did see a little bit of that in the past month, but it's usually only short-term. If you start to see prolonged sell-offs, you're going to want to have duration in your portfolios.
And finally, I just wanted to get your view on where next for the dollar.
I wish I had a crystal ball for the dollar. I think that it is very, very hard to get currency moves right. But look, if we're right and the Fed is going to end up having to be more aggressive, we think that is our base case. We know the ECB is going to be on hold, at least actually raising the rate. There'll be some tapering, but it's going to be a while till they start raising rates. And we know, you know, Bank of Japan is a long way away. That just means that all else being equal, the dollar should continue to rally. Now, whether it actually rallies against some of the higher beta EM currencies, I think has a lot more to do with the fundamentals in those particular EM countries. But against, you know, against the euro, against the pound, against the yen, I think the base case we should expect a dollar to continue to rally.
Gershon, thank you so much for your time.
My pleasure. Thanks for having me.
That was Gershon Distenfeld, co-head of fixed income at AllianceBernstein. I'm Victoria Scholar. Thank you for watching IGTV, and we'll see you very soon.